A bumper US jobs report has seen off a week that has seen plenty of volatility and geopolitical concerns, with the potential for a flare up in the Middle East raising oil prices. But in terms of US data, we have seen outperformance across many of the metrics seen over the course of the week just gone, ending with the US jobs report, where we saw lower unemployment, we saw a massive bumper NFP figure, and by and large, people casting aside the idea that we might see a 50 basis point cut from the Federal Reserve in November. Well, for the week ahead, we've got plenty more to look at with the likes of the RBNZ rate decision. We've got US inflation, Fed minutes, and the UK GDP figure. So let's get into it. So here's the big ticket items for the week. We can see that really things start to gather momentum on Tuesday, where we see the RBA meeting minutes, and then really it's Wednesday. We see the RBNZ interest rate decision. As you see here, trading economics pointing towards a 25 basis point cut. I think there's a good chance we see 50, and we'll get into that. Then we've got the Fed minutes that evening. This is UK time at 7 p.m. Thursday, we have inflation coming out of the US, and we round up the week with a focus on the UK with the raft of data. Sort of front of center of that is the GDP figure. Then we've got the Canadian jobs report, which on this occasion is split out from the US just gone. A week later, we see the Canadian numbers, and then we see US PPI and consumer sentiment figures out of the University of Michigan. So here is the outlook for the US over the course of the coming week. And certainly we have been seeing a lot of speculation over the direction of travel for interest rates in the US. Will it be 25? Will it be 50 in November? Well, the week just gone would point towards 50, towards 25, because we saw outperformance in terms of the JOLTS job openings number. We saw a stronger ISM manufacturing PMI, stronger services PMI, ISM version of that. We saw the ADP number coming in relatively strong. And then we topped off the week with a bumper payrolls figure, a decline in terms of unemployment, and the idea that we might see a US recession really appears to be out the window for the time being. Well, as we come into this week, we're going to, of course, keep an eye out for the outlook of the Fed members and how they are preparing to close out this year with just 2 meetings left. And then on Thursday, we have the inflation figures coming out of the US. Bear in mind, generally, the Federal Reserve likes to keep an eye on the core PCE metrics. So I like to utilize the headline CPI number, then the core PCE figure. So here's the outlook across those. So you can see here that by and large, the green line, which is core CPI, and the purple line, which is core PCE, is sort of flatlining of late. It's the CPI number, which continues to move lower with 2.53 on the latest figure. But nonetheless, they're in the mid twos. It does provide the basis for the Federal Reserve to think they can start to move. They don't necessarily want to reach 2% by the time they start to act, because by that point, it might be too late. You want to act ahead of time to sort of start to turn around the economy, because it takes a bit of time. So here's a breakdown in terms of a number of the different metrics that are relevant to CPI. As we can see here, shelter, a third of CPI. And so shelter prices are absolutely key. You can see it in the light blue at the top end. We did see it turn higher. So the ability to see shelter roll over once again is going to be absolutely key to driving down that headline metric. In terms of services, though, services inflation is a massive part of this story, quite frankly. A lot of the sort of good side of it has been disinflationary. And you can see it in terms of the latest ISM numbers. We saw continued weakness, sub 50 for manufacturing, but a bumper ISM services PMI number. We did actually see a decline in terms of the employment side of things, but certainly from a sort of prices perspective, services continues to be the main driver of inflation. 4.3 when you strip out the services element, but certainly moving in the right direction. There is an expectation we will see further downside, though. As you see here, the September figure of 0.36 is being stripped out. If you look at the past 4 occasions, all of those figures have been below 0.36, significantly so. I have my sort of target rate here, which is essentially the figure we need to hit for us to get back to 2%. I think that's something like 0.166 recurring. And we've been there or below on the last 4 occasions. So if we see something similar this time around, you're pointing towards a potential disinflationary move coming to the fore here. 2.59 to 2.6 on the last figure. If we look in terms of expectations, there's an expectation for 2.3 on the headline figure, and core inflation down to 3.1 from 3.2. So we do expect to see disinflation. And so what's the outlook? Well, this was sort of screenshotted just before the payrolls. And so this is going to be even more stark, quite frankly, by the time, things open up on Monday and we've seen market moves. Markets are increasingly pricing a 25 basis point cut, not a 50 basis point cut for the November meeting. That is currently roughly 70%. That's probably going to be, definitely will be higher than that after we see it pricing in what's happened in terms of the jobs report. And what's happened off the back of that? Well, we've seen strength in terms of the equity markets, strength in terms of the US dollar. Generally, we see the US dollar and equity markets moving in the opposite direction, a so-called negative correlation. However, this time around, it's different. And we can see why. Look, if you're looking in terms of the US dollar, the idea that we're going to see a slower pace of tightening is the basis for a stronger US dollar. The more we see easing, the faster the easing, the weaker the dollar. However, in terms of the equity side of things, of course, when you're looking at equity markets, there had been this big risk recently that we could be heading towards a recession in the US. That appears to be fading. And so if we were going to have a recession, yes, it could potentially ramp up the pace of easing. But it's not what we want to see, because suddenly it starts to undermine the valuations within the equity markets for earnings and the like. So you have this situation where the US dollar is rising, where we're also seeing equity markets rise. Now, I wanted to bring up the chart for dollar Swissy. I think this is a really interesting one. Recently, we've seen this sharp decline, another really low negative monthly reading for Swiss inflation. And what we're seeing here is a rebound coming into the fore for the US dollar against the Swiss franc. Now, what's notable here is that there is likely to be a possible continuation of this rise that we're seeing in terms of energy prices if we see a flare up in the Middle East. That is one of the big risks within markets at the moment. So we have the risk of a rebound in terms of energy to the extent where it starts to raise inflation expectations. That would be a problem for the Federal Reserve and would slow the pace of easing. That wouldn't be a problem for the SNB because they've already got inflation that's well below the 2% mark. And so we start to see, where would that haven role come into play? Would the second wave of inflation, if that comes into the fore, and if we see energy prices rise, and if we see a conflict in the Middle East widening into Iran potentially, that to me provides the basis for potential upside for the US dollar against the likes of dollar Swissy. The fact that we're seeing that repricing towards a stronger economy, but a sort of slower pace of easing from the Federal Reserve, that provides the basis for upside for dollar Swissy. In terms of the daily time frame, you can see that we've broken out now from this consolidation that's really dominated the last month. The question mark here is whether we are essentially within another retracement or not. And therefore, we'll look in terms of the fib levels and say, okay, so far we've tagged that 61.8 at 0.86 absolutely perfectly. If we move beyond that, 0.866 is the next resistance level. Certainly a breakup through 0.874 provides the basis for a wider rebound. But certainly if we see a risk off move coming to the fore on the idea that we're going to see increased conflict, or if we see it, or if we see higher oil prices, I think we see benefits for the US dollar because of the impact on inflation and the fact that higher inflation is likely to impact the US more than it would decision making at the SNB. So this is an interesting one to be looking out for the time being, given everything that's happening on the macro scale. Next, I wanted to show you the outlook for the UK. So we've got a host of UK data points released over the course of the week. This comes off the back of comments from Andrew Bailey, who has essentially said that we could see a faster rate of easing, and that started to increase calls for a rate cut at each of the following meetings. Then we started to hear from the chief economist Pill, who essentially has said, well, actually, I favor a much slower pathway lower because I want to see inflation, what is left of inflation, driven lower. And core inflation remains elevated in the UK, despite the fact that headline inflation has seen a nice move towards the downside. Well, what's happening for the week ahead in the UK? You can see here we've got Friday really is when it's all happening. GDP coming out for the month of August. We've also got the trade balance data, industrial production, manufacturing production, balance of trade, the year-on-year GDP, industrial. We've got a whole host of metrics being released. And this highlights a potential trajectory for the FTSE 100 where potentially, if we were to see say strong UK economic picture, you're pointing towards a possibility that we see a slow pathway lower. If we see a weakening economic picture, then we're likely to see a quicker pathway lower in terms of interest rates. And that's going to impact the FTSE 100. Bear in mind, the FTSE 100 generally lags many of its peers. And I think it's likely we see something similar if we see a relatively strong reading coming out here. The caveat here is that the FTSE 100 does provide a nice, somewhat of a hedge at a time when we're seeing geopolitical risks being raised. A number of reasons for this, but essentially when you see markets selling off in a really meaningful manner, it's generally the FTSE 100 which doesn't fall by as much. So it's unlikely to rise as much, but it's unlikely to fall as much, in part on this occasion because the idea that the risks are born out of a rise in terms of energy prices, well, that kind of feeds into the FTSE 100 because of course we have a heavy weighting towards the likes of Shell, the likes of BP. But the flip side of that is it's a highly internationalized market. And therefore, when we see the devaluation of the pound, so you see the value of assets abroad, or value of earnings abroad increase in turn. And of course, if you see a risk off move, that generally will drive down the pound against the US dollar. You see that pound devaluation, you see the value of those earnings of companies earning abroad in the US dollar rise. And that provides somewhat of a cushion for the FTSE 100. This is the outlook in terms of the interest rates for the time being. You can see here that the expectation is that we will cut at every meeting, essentially over the next 3 meetings, although it's a coin toss in February, but the remaining 2 for this year are increasingly being priced in as a rate cut. That has adjusted a little bit since those pill comments that essentially rode back on some of what Bailey has said. But certainly markets are trying to gauge exactly where we go from here in terms of interest rates. And with the fact that, yes, they seem nailed on for November, but there's a lot of indecision for every meeting beyond there, that leaves a lot of conjecture. It leaves the potential for volatility going forward in terms of UK related markets. This is the FTSE 100. We can see here that whilst we haven't necessarily seen a huge sort of really impressive upward trajectory, I would say that we've got a nice stepped trend here and we're seemingly stepping higher once again. So we come often into very deep retracements, but until we see a breakdown through that price swing low, then you're pointed towards another move towards the upside. We're kicking off in that vein at the moment. And so I wouldn't be surprised to see this gradually moving towards the upside and start to move back towards your 83.40, 83.60 resistance level for the FTSE 100 with a breakdown below 8229 required to negate that view. And finally, let's bring up the outlook for New Zealand. You can see here the key event really happens on Wednesday. Well, it might feel like Tuesday night to me because it'll be 2 a.m. So it's essentially a meeting where we're expecting to see a rate cut, but the question mark is to what degree, right? We saw recently a sharp decline in terms of the Australian inflation rate, but certainly the differential between the RBNZ, which continues to cut, and the RBA, which continues to hold off, has provided the basis for strength for the Aussie against the New Zealand dollar. And this time around, whilst trade and economics are pointing towards a 25 basis point cut, we can see here the London Stock Exchange Group on the Icon platform signals a 96% chance that we see a 50 basis point cut. Markets are expecting a significant cut this time around. And from here on in, you're looking for the potential for cuts at each and every meeting until the middle of 2025. essentially, you're looking at a potential for a continuation move with the strengthening of the US dollar, the weakening of the New Zealand dollar as they ease, and that's exactly what's happening at the moment. The weekly time frame shows you we pulled back into the 61.8 rally, pulled back into a very deep retracement, but the bulls are back in charge, and we're approaching this key resistance level, as you see here, at 1105. A breakthrough that level certainly gives us greater confidence that this sell-off, so ABC style retracement, is over, and that the bulls are back, and that will rally back into your 1115 and beyond. So the more dovish the RBNZ are, the more likely we are to push onwards and upwards from here. And certainly a breakthrough this 1105 would give us greater confidence of that move. If you look towards the downside, 1085, that's the level that needs to be broken to negate this recent rebound. And so it does look like that trend's back in play, in particular if we see a break through that 1105. I hope this has been useful. Be aware that perhaps the biggest mover in this market at the moment could happen from events in the Middle East. We don't know what will happen or if it will happen, but certainly this is something you need to be keeping an eye out for, because this potential for a left field event, something that isn't on the economic calendar, does have the possibility to really impact market sentiment. Perhaps and hopefully it's not as bad as we think, and we will see relative calm within markets, and we'll see a relief rally. But at the moment, there's some market jitters. There's markets are really sort of taking a very cautious approach. And as we head towards the US earnings season and the US election, really at the moment, there are really significant concerns for equity markets that are likely to provide a cautious approach, despite the fact that we have seen this strong recent data coming out of the US in terms of the likes of the ISM numbers, the jobs report. There's still plenty of questions that traders like yourself will be asking about whether we should feel completely confident in the bullish sentiment to continue that big long-term uptrend for equity markets, given what's happening in the world right now.